Most people think central banks exist to keep the economy stable. That's the story. The uncomfortable truth is this: central banks don't just control money. They quietly shape behavior. They reward some actions. They punish others. And most people never realize it's happening. Right now, your biggest financial decisions are being influenced by people you will never meet, using tools that sound boring, technical, and harmless. Interest rates, liquidity, forward guidance. Dry words, huge consequences. Because when central banks move, they don't tell you what to do. They change the incentives. And humans always follow incentives. Let's talk about how that actually works, and why it matters more now than it has in decades. Not long ago, saving money was considered responsible. You worked, you saved, you earned interest. Time rewarded patience. Today, that logic feels broken. You save cash, it shrinks. You wait, prices run away from you. You avoid risk, you fall behind. That didn't happen by accident. It happened because central banks rewired the game. To understand how, we need to strip away the jargon and look at the system the way it really operates. Central banks sit at the center of modern economies. They don't make laws. They don't set budgets. They don't vote. What they control is the price of money. And the price of money controls behavior. When money is expensive, people hesitate. When money is cheap, people move. Borrowing, spending, investing, speculating. All of it responds to the same signal. Interest rates. Think of interest rates as gravity. High gravity keeps things grounded. Low gravity lets things float. When central banks lower rates, borrowing feels lighter. Mortgages look manageable. Business loans feel safe. Debt stops feeling dangerous. When rates rise, gravity returns. Debt feels heavier. Mistakes become costly. Risk suddenly matters again. But here's the key part most explanations skip. Central banks don't just influence the economy. They influence incentives at every level. Start with households. When rates are low, saving makes no sense. You put money in the bank. You earn almost nothing. Inflation quietly eats it. So what's the incentive? Spend now. Buy assets. Take a mortgage. Reach for returns. Even cautious people feel nudged. Not forced, just nudged. Now look at companies. Low rates make borrowing cheap. Instead of waiting years to save up, companies can borrow today. They can expand faster. Buy competitors. Buy back their own stock. Leverage the future. Debt becomes a strategy, not a risk. Executives get rewarded for growth now, not resilience later. And when money stays cheap long enough, that behavior becomes normal. Expected. Then there's governments. This is where things get quietly absurd. Low interest rates make debt feel painless. Governments can run deficits year after year because servicing the debt costs almost nothing. There's no immediate penalty, no market rebellion, no angry bond vigilantes. So the incentive is obvious. Borrow more. Delay hard choices. Promise more today. Central banks don't tell governments to do this. They just make it easy. And easy choices are the ones humans take. Now zoom out. When everyone is responding to the same signal, you don't just change behavior. You change culture. An entire economy begins to prefer speed over stability, risk over patience, leverage over savings. This is where the system starts to feel strange. Because central banks are supposed to reduce risk, but their tools often encourage it. Not in obvious ways, in quiet, rational ways. If borrowing is cheap and returns are scarce, taking risk becomes logical. Not reckless, logical. That's how bubbles form without anyone feeling stupid. Housing, stocks, crypto, venture capital. Each one followed the same pattern. Money gets cheaper, risk looks smaller, prices rise, confidence grows, and then the incentives flip. That flip is the part most people never see coming. Because central banks don't just set rates. They manage expectations. This is where things get subtle. Central banks spend a lot of time talking. Speeches, press conferences, carefully chosen words. Not because they like talking, because expectations move markets. If people believe rates will stay low, they behave differently today. They borrow more. They invest more aggressively. They push further out on the risk curve. So central banks guide expectations. We will support the economy. We will act if needed. We are committed to stability. These phrases sound reassuring. They are also incentives. They tell markets, don't worry yet. And markets listen. Over time, this creates something dangerous. Dependence. Investors begin to assume that when things go wrong, central banks will step in. This is sometimes called a backstop, but in practice it becomes a habit. Risk builds on the assumption of rescue. Losses feel temporary. Upside feels permanent, until inflation shows up. Inflation is the moment the system fights back. Because inflation breaks the illusion that money is neutral. It reveals the hidden math. When central banks keep money cheap for too long, purchasing power leaks out. Prices rise. Wages lag. Savings suffer. The incentive flips again. Now holding cash is punished faster. Now spending feels urgent. Now long-term planning becomes harder. This is where the tension really starts. Central banks are forced to choose between bad options. Raise rates and hurt borrowers. Or keep rates low and hurt savers. Slow the economy and risk recession. Or support growth and fuel inflation. There is no clean solution. Every move reshapes incentives again. When rates rise, the story reverses. Debt becomes dangerous. Asset prices wobble. Companies cut back. Governments feel pressure. Suddenly, the behavior encouraged for years is punished. The same leverage that once looked smart now looks reckless. And here's the uncomfortable part. People blame themselves. They think they made bad choices. But many of those choices were perfectly rational under the incentives at the time. That's the power of central banks. They don't command behavior. They design the environment. And humans adapt. Now let's address the hype versus reality. The hype says central banks are all-powerful. That they control the economy with precision. That they can fine-tune outcomes. The reality is messier. Central banks react more than they control. They respond to data that's delayed. They rely on models that simplify reality. They make decisions under uncertainty. And once incentives are set in motion, they're hard to reverse. You can raise rates in a meeting. You can't instantly undo years of behavior shaped by cheap money. That's why tightening cycles feel chaotic. Why markets overreact. Why things break in unexpected places. Because incentives don't unwind smoothly. They snap. Now zoom out even further. This system shapes inequality. Asset owners benefit most from low rates. Those without assets fall behind. It shapes politics. Cheap money delays hard decisions. Pain gets postponed, not removed. It shapes the future. More debt today means fewer options tomorrow. And none of this requires bad intentions. Central bankers are not villains. They are technicians operating a blunt tool in a complex system. But incentives don't care about intentions. They only care about signals. So here's the quiet question this leaves us with. If central banks shape behavior by changing incentives, and incentives shape risk, inequality, and long-term stability, then what happens when the system becomes dependent on signals that can't be sustained? What happens when cheap money stops working? That question doesn't have a clean answer. And that uncertainty is the most powerful incentive of all.